seats here and keep moving forward. If there's anybody out there, you just might want to let them know.
Okay.
Ben.
Can we push that one aside?
Thanks. Last week we announced to you a new service called Masters of Wall Street. Did everybody get that? Because some of the people have told me they're not sure if they've seen that email from us, but did you guys see that? Did you get the top stock email that went out, I believe, on Monday or Tuesday of this week? People recall seeing that? Okay, I'll double check. I'm not sure. You know, we've had a couple little technological glitches with getting this launched, but we'll make sure it's running properly when I get back next week. Masters of Wall Street's a kind of a new endeavor for us because unlike our other publications that take more of a qualitative approach to picking stocks, I view Masters of Wall Street as really more of a tool to help you either evaluate the stocks that you own or are thinking of buying or selling, or as a source of ideas that's purely quantitative in nature. And I'm not going to steal John's thunder. You're going to explain the whole process, right? So I'll leave it up to him to do that. But this one's a little bit different from our, it's a publication, but it's different from our others, and that it's not so much the narrative that's the essence of the advice. It's really the underlying mechanics that he's going to explain. It takes a little while to really get your head wrapped around it. I mean, here I am, somebody that's been in this business for 30 years, and I was on the website for a couple of hours before I really had it totally figured out. And once I did, I thought, hey, this is really cool. You can do a lot of interesting things with these tools. John, I'll just make a real brief, quick introduction. When John was a junior in high school, basically I think he was just bored and applied to MIT and was accepted and just skipped the senior year of high school and went straight to MIT. Would you go, were you 16 years old as a freshman? Yeah, 16 years old as a freshman at MIT. Got 2 degrees?
Degree in computer science and
three, I'm sorry, 3 degrees from MIT, my bad. And then a master's, right?
Master's in MBA, but
an MBA.
Different school.
So John was one of the pioneers in artificial intelligence, went on to start his own company, was very successful with it, and sold it at a young age with enough money to effectively retire if he was able to manage his money well. And that got him curious about the whole investment advice industry. He started, I believe, interviewing stockbrokers and financial advisors, and quickly came to the conclusion that didn't really seem to be as much of an exact science as maybe most people would expect. So with his background, he started reading books by some of the all-time great investing legends, and then took his artificial intelligence expertise to essentially write algorithms that would mimic the thought process of all-time great investors. And once he did that to manage his own portfolio, decided, hey, I've got a pretty neat thing here. Started managing some money. We approached John and said, hey, we'd like to offer this in the form of a publication to our subscribers. So just earlier this month, we have formally launched Masters of Wall Street. I'll let John kind of talk about the track record and how it works. But this is another tool that I really think you need to take a hard look at and understand how it works. So with that said, I'll turn it over to John Reese. Thank you.
Jim, thank you very much. I am going to try to speed this up a little in recognition of the time. So I may cut through some material here. But before I begin, I'd like to ask the audience a few questions so I can best relate to you and share some of my story with you. Could I see by show of hands how many of you still hold individual stocks in your portfolio that you're actively managing? Okay, so basically almost everyone in this case. How many of you have studied or read the strategies of famous investors? Actually, like 90% of you. How many of you have tried to implement the stock picking strategies of those investors but lack the discipline to follow them? Okay, about half. How many of you have some type of screening or idea generation tool that you're currently using to pick ideas? Any tools or online? Again, the vast majority of you. And finally, how many of you use stock fundamentals, not technical analysis, but stock fundamentals such as price to earnings ratios or growth ratios or return on equity to help you choose the stocks? Okay, excellent. So the goal of my presentation today, I'm going to present to you 3 quantitative investing strategies by really highly successful investing masters. I'm going to be using Peter Lynch, Warren Buffett, and Benjamin Graham. I'm going to discuss an investing framework that can help you become a better investor, and I'm going to look at a few investment ideas that you might actually be interested in right now that's live on the investing website, Masters of Wall Street. So a little bit about me to add to what Jim had said. I'm also the author of the book, The Guru Investor, How to Beat the Market Using History's Best Strategies. I have an MBA from Harvard Business School. My undergraduate degree was at MIT. Columnist for Forbes, Real Money, Globe and Mail, and several other sources right now. 2 patents in the area of automated stock analysis, and also an SEC-registered investment of Validity Capital Management. So Jim's right. How I sort of got into this was that I built up my first company, technology company, Local Area Networks, sold that off to GE Capital, and was faced with how do I invest on my own. I'm going to skip to you a lot of the trial and error. What I did that was finally successful is I came across certain books out of many of the hundreds that I read, the one key one being One Up on Wall Street by Peter Lynch, my original copy of this, where the key thing was, here was somebody who had a proven track record, who wrote in a book in a very detailed manner how we went about picking stocks, and furthermore, there are essential steps in this that are quantitative that could actually be computerized, very essential. I then came across other investors. This one was Benjamin Graham, his Intelligent Investor book, that also became the basis of these master strategies. So besides Peter Lynch and Benjamin Graham, who I just mentioned, the other investing masters include Warren Buffett, Ken Fisher. Ken Fisher, about 30 years ago, wrote a book called Super Stocks that became the basis of this. Now, he has evolved his own methods and manages things different. I've still stuck with his original strategy, which, interestingly enough, the original strategy has continued to do stellar. David Dreman, known as the original contrarian. Marty Zweig was on Wall Street Week with Louis Rukeyser and had the best risk-adjusted returns over 15 years, according to the Holbert Digest. James O'Shaughnessy, who wrote some seminal works on what works on Wall Street and analyzed over a 45-year period what works best. John Neff, who was the manager of the famed Windsor Fund for over 31 years, had a fabulous track record in beating the S&P 500, and a few others. So why these masters again? One, they developed a framework to select stocks that basically delivered market outperformance. Very key. So we're taking something that has a very long-term track record in market history. These are not just short 1, 2, 3 year success strategies, but very long-term. They publicly disclosed their strategies in a book or other paper that gave me sufficient information, and further, they had to have within that a quantitative strategy that could be leveraged using the artificial intelligent computer program. All 3 had to exist. There were many hundreds of candidates for books, but it really boiled down to just a handful of these masters. So I'm going to actually take you through the quantitative strategy first of Peter Lynch, who is the star fund manager of the Magellan Fund. His track record was over his 14-year period or tenure, he averaged about 29% per year in terms of his annualized returns. This may be getting a little too detailed, but actually one of the key things that I hope to share with you are what are the important variables to really look at? What do these masters look at to judge whether the fundamentals of good or bad or worthwhile investing? That was a question that had always fascinated me because